Warren Buffett was once told in the '08 crash, "Mr. Buffett, you have lost $10 million today." Do you know what he said? He said, "I haven't lost anything. I haven't sold." Me and Buffett have the same mindset. I'm tens of thousands in loss on my Euro USD trades, but I haven't lost anything because I haven't closed the trade. No stop loss. We share that mindset, and inshallah, the markets will turn around and I will be profitable. That's the problem with these traders nowadays. Stop losses, closing their trades. Don't close, don't lose.
Exactly, yeah.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and August is officially done. Markets finished higher on Friday, leading to the fourth straight winning month in a row. August was positive despite all of the volatility, and today's trade was an everything rally. I mean, excluding United Health, right? American Express, Apple, and a couple of names here in the energy space, it was a green day across the board. Tesla up 3%, Amazon 3.71%. Semiconductors led the gains in technology. Financials were very positive across the entire sector. It was just a green day across the board, a broad-based rally, with the best sectors being consumer discretionary and technology. Now, they were the worst performing sectors yesterday, so having a bit of a bounce back, and the worst performing sector being energy, but still up 0.3%. A very solid day, a risk-on day, because consumer staples, utilities, healthcare, these defensive sectors were at the bottom of the heap. But these are still exceptional gains nonetheless, and you take them. And what really cemented the rally early was some of the economic data we got before the market opened. This caused the market to be very frothy here at midday. Then we paired some of these gains. Stocks kind of had a mid-afternoon slide. However, we put in a bottom around the 12:30 mark, and then we made higher highs, higher lows, and in most cases, actually taking out the highs made in the early morning session trade, closing at the high of the day, with the Nasdaq being the best performing index, up 1.2%. The S&P 500 pretty much a percentage point, the RSP in third place, the IWM up 0.66%, and the Dow Jones up half a percentage point, but that's another new all-time high close for the Dow Jones. Across the spectrum of stocks, large, mid-cap, small, value, core, and growth, it was just an everything rally today. Large growth really outperformed. However, in the mid-cap and small-cap sectors, we really saw core perform the best. But it was a rally regardless. Even internationally, we saw green across the board. And today's rally all stemmed off the macro. We got very encouraging macro data, especially considering that the Fed are paying very close attention to the data we receive now for rate cuts in September. Now, the big point was the inflation data. We got PCE month over month, year over year figures. That clocked in at 0.2 and 2.5%. That was the median forecast, but this is where it got really interesting. Core PCE came in at 0.2% month over month, but the year over year figure for core came in slightly cooler than expected, 2.6% versus 2.7%. And that's where the market was really upbeat. And that is in the context of personal income reporting 0.3% versus 0.2%, and then personal spending or consumption coming in line. Very upbeat data. So the average consumer actually saw their incomes grow greater than what inflation grew here on the month, both at the core level and the headline level. However, inflation did disinflate according to trend, and on a core PCE level, it actually came in lower than expected. So lower inflation, stronger buying power, with consumption staying robust. That is Goldilocks data, and that is why the market rallied. Extremely encouraging data heading into next week's data prints, which is NFP, and that is why the market was so bullish today. And that is why we actually saw yields rise. Yields were up 1.14, 1.25% in the 10-year and 30-year yield. The dollar gained as well. And when the dollar gains, commodities are not going to do as well. Gold and silver were down 0.7 and 1.98%. But equities were the real standout performer today. The S&P 500 up a percentage point, the Nasdaq 1.2, mid-caps 0.75%. The RSP was up as well. Slight weakness here in the after hours, but really inconsequential. tiny bit of risk off heading into this Labor Day long weekend. And the S&P 500 closed August at a monthly high right here. That's a monthly closing high. For all of the drama we had in August was actually rather bullish. We saw gains across the board in the major indices from the start of August. It was peak bearish sentiment right here, peak pessimism. People thought we were going to go back to 4,500, the start of the next crash, but we put in a very nice bottom, and we actually saw all of the major indices, excluding the IWM, which is the Russell 2000, pair all of their losses in August. This was a great dip buying opportunity, and the RSP up 2.5% for the month, the S&P 500 roughly the same, the Dow Jones and Nasdaq up 1.641% for the month. But had you bought the dip right here, you're looking at a trough to peak gain of anywhere from 6 to 8%, a great dip buying opportunity, and actually a very bullish August nonetheless. When we look at sectors, the best performing sectors, however, were staples, real estate, healthcare, utilities, defensive sectors up at the top, because they didn't actually have as a dramatic drawdown at the start of the month, but they did follow the market flows to the upside when stuff like tech, discretionary, and the broader market put a bottom in, and that is why they were the best performing sectors. But also there's context behind that. Stuff like real estate, the market is buying that up in regards to rate cuts. Now, the worst performing sector was energy. It was down 2.11% for the month. Then discretionary, it was down 0.16%. Those were the only two negative sectors for August. Technology is actually positive when you think of it. It was up 0.74%. Communication services up 1.83%. So the magnificent 7 sectors, XLC, XLK, XLY, didn't perform the best, and this just goes to the continuing broadening out we're seeing in the market, with the S&P 500 sitting right here in the middle, up 2.39%. Actually a very bullish August, especially considering the broadening we saw this month, which I do think will continue throughout 2024. And the monthly candle for the S&P 500 is officially closed here for August. That is a bullish candle when you look at it, especially considering this long wick, a green close, very, very bullish. Peak pessimism at the bottom here, but a bullish candle nonetheless. And when we do zoom out, we can see that the S&P 500 is very clearly in an uptrend. We're making higher highs, new all-time highs. That's a new all-time closing monthly high, by the way. And we've made lower highs, and that looks like a lower high right now. That does warrant further upside in the S&P 500. Now, if we just zoom in a little bit closely here on the month, things are looking rather bullish. And the only way I get bearish on the S&P 500 is if we start seeing price action and price discovery sort of around this area right here. Let's call it the 4,800, 4,898. Let's actually go ahead, just make that 4,900. We start seeing price discovery around here below this area. That's when I get worried, simply because it's where we put in these highs kind of right here. It's not an exact science, guys. We did have a little bit of digestion right here, and we did actually have the big red monthly candle in April. We found the bottom right here, and we've rallied up ever since. So when we get to this 4,900, and you could maybe say plus minus 100 points, maybe the 5,000 area, maybe the 4,800 area, when we start having consistent price discovery in this area, that's when I could get a little bit worried in the S&P 500. But as it is right now, I'm not worried on the monthly chart. This to me looks bullish. Diving into the weekly chart, very nuanced, very similar situation. Higher highs, higher lows, in the context of pretty much new all-time highs. Now the weekly chart looks every much as bullish as the monthly chart. And on the weekly chart, the line I'm looking to get bearish below on a technical basis is simply this line right here, the 52.82 level. Let's go ahead and make that a different color. Below 52.82, the second we get a weekly close below this area, we can then target the monthly support zone. But as long as we're above this area, I remain constructively bullish, and you want to be buyers of dips. And this area, the 52.82, should provide very solid support, because it's where the market found a bottom right here a couple of weeks ago at the August lows. And it's also where we did go ahead, put these all-time highs, and saw a little bit of volatility for about 3 weeks before finding support at the monthly support zone zone and then making the rally to new all-time highs. So 52.82, very, very bullish. I remain constructively bullish above this area right here in the weekly, and I want to be a buyer. But the second we go below here, I remain bullish on a monthly basis, but we can actually see some downside on a weekly basis all the way to the 4900 area. Hopping onto the daily chart, we see things become a lot more nuanced. Looking at year to date, similar to what we saw with the monthly chart and the weekly chart, higher highs, higher lows, and now the monthly and weekly zones look like very, very key support levels. You can see resistance right here, support, a bounce up, rally to new all-time highs. We pull back from price discovery at this area and then bounced up to new all-time highs. Very, very bullish. Now on the daily chart, we don't really have key support zones based on former support and resistance levels. We just look at the gamma situation. Now we're actually going to go ahead and look at that on the SPX chart, and you can see that 5550 is still the gamma flip. I think that's going to change. I think it's going to move higher into next week. We're going to see what that looks like, but as it is right now, it's 5550 is the gamma flip, 5450 is the put support, 5700 is the core resistance. This is our upside target, this is our downside target, and we target upside or downside above the 5550 area. And to me, this looks constructively bullish. Yes, we had quite a bit of digestion right here, but looking into next week, a lot is going to be dependent on the macro. Expect more of this into Thursday, into Friday, and then from there we should get the outsized move. And that's generally what the market's going to do until we actually get those rate cuts, especially out of earnings season. We're going to digest gains, wait on the data, and once we get the data, the market is going to make its move. And it's far better to be reactive in this market than predictive, because predicting economic data is really, really hard. And that's why you want to follow the plan. And the plan is to buy dips, sell rips above the gamma flip. We are in positive gamma, and to sell into weakness, buy into strength below the gamma flip. We are in positive gamma right now, and so our aim is 5700, buy dips, sell rips, and take advantage of opportunities if the macro data gives them to us. One such opportunity was this right here, and we'll see if we get more opportunities this week. We are heading into September, seasonally the weakest month, and I am expecting volatility, and I am prepared for it. I have a lot of cash spare. I'm sitting at about 39% in cash right now. That's because I've been selling a lot of my Visa position, but I am expecting a lot of volatility in September. If we don't get it, doesn't matter to me. We're already positioned. But for now, guys, and you want to remain constructively bullish, especially as the monthly and weekly charts look incredibly bullish right now. August 2024 is officially in the books, the most volatile month so far of 2024. And the truth is, things can get crazy because we have September, which is the most volatile month in the S&P 500. Data going back to 1950, you can see that the average month is only positive 46% of the time in September, with a lot of the negative days back end loaded here in September. And it's far better illustrated on the line chart. The seasonal performance since 1950, we see flat to slightly up returns into the 18th, 19th, and 20th of September. We then form a top and make lower lows, lower highs into the month of September, where we normally see drawdowns anywhere from 0.6 to 0.8%. And September tends to be a brutal month. But in election years where we don't get a recession, things can look a little bit different. In normal election years, we see volatility from about the start of September into late October, early November. But in years that don't end in a recession, we kind of just make higher highs, higher lows, very similar to what we're doing in the S&P 500 right now. Although we haven't really made a new all-time high since late August, early July in the S&P 500. So it's yet to be seen what happens. That being said, myself, I am preparing for volatility. I'm expecting the worst, hoping for the best. I'll be positioned regardless, and I am ready to buy the dip. So whether we get this or this, it doesn't matter to me, and I will take things as they come. Now, what could support equities in the month of September, and to be honest, from now throughout 2025, is actually the dollar. The BOFA implied DXY, which is just the US dollar versus a bunch of G20 countries and their currencies, their implied forecast for the dollar to move lower. And that's going to be supportive for equities. When the dollar falls, equities tend to do very, very well. But when the dollar gains, equities tend to churn right here in this chart. And if the dollar or the DXY weakens against the other G7 countries, that's going to be really good for equities, particularly large caps and those companies that have large exposure to international revenues. And looking at earnings, this is the most up-to-date earnings figures for revenue, earnings, and margins. And right now, margins are sitting at 12.2%, very robust margins. These figures right here is what analysts were expecting at the start of earnings season. EPS blended earnings estimates is sitting at 12.5% and revenue estimates sitting at 5.4%. The best performing sector on the revenue side is the technology sector, and then on the earnings side, it's financials, and the worst performing sector is simply the material sector, both on the revenue and the earnings side. If you exclude energy, revenue is a little bit softer, and so far for the second quarter, 78.8% of companies have reported above analyst expectations. The long-term average, by the way, is 66%. And let's dive into some macro analysis. This is the economic surprise index. Now, throughout 2024, guys, we've seen economic data come in very, very soft. The Fed wanted this. This is why they raised rates, and this is why we've seen inflation do what it has in the last 6 to 12 months. However, despite the weaker than expected data, we have seen data strengthen since about July after we got the terrible non-farms, and data has come in slightly better than expected, although not blowout data prints. A lot of them have slightly been beating or just coming in line within the standard deviation. Now, what did surprise to the upside yesterday was second quarter GDP revisions, and real GDP growth has clocked 2.8% annualized since the Fed amped up tightening 2 years ago, thanks to services spending and government spending. GDP currently sits at 2.8% annualized in the last 8 quarters. In fact, the 2017 to 2019 average was about 2.8%. And this has come on the back of a collapse in residential fixed investment, which is essentially just housing, real estate. No surprise there. Rates go up, housing is going to collapse. And that was more than offset by government spending, non-residential fixed investment, which is business investment, and then goods and services consumption. All in all, the US economy and growth looks really robust, and the inflation picture looks really good as well. Inflation continues to moderate and decelerate to the downside. Disinflation is well underway, but the big thing about today's inflation report actually had to do with personal income outlays. Disposable income and employee compensation continue to run above the rate of PCE. This is the 1-year annualized, 6-month, and 3-month annualized figures. Disposable income is running at 3.6% on a 12-month annualized basis. Employee compensation at 4.4%, whereas PCE inflation right now at 2.5%. Real income growth is still very strong, and this is very bullish, because if we have continued disinflation, softer PCE prints on the way to 2%, and actually continue to see employee compensation and disposable income rise, that's very bullish. And that is the average consumer gaining pricing power against the rate of inflation. You want that because that just leads to a healthy consumer and a stronger consumer. And at the same time, real consumption growth is also running above the pre-pandemic average. On a 12-month annualized basis, services growth and goods growth running at 2.9% and 2.3%, and total real consumption running at 2.7%. The 2018-2019 pre-pandemic average was 2.1%. And despite inflation moderating, we're still seeing very robust levels of overall consumption. And with inflation continuing to moderate, this simply increases the real rate of credit, the real cost of capital. This is the Fed funds rate, which is 5.5%, minus the trimmed mean PCE inflation rate. The difference between the two is real Fed funds. Above this line, the Fed is too tight. Below this line, rates are too easy. The Fed kind of wanted in between a 0 and 1% range. Right now, we are sitting at about 2.5%. Real Fed funds, or the real cost of capital, is way too tight. And there's many ways you can actually decrease this rate. Number one, you can actually just increase inflation overall. You increase inflation, the real cost of capital is going to come down. Or you can just decrease the Fed funds. Now, the thing with inflation is that it can get out of control once the cat is out of the bag. So the Fed would rather just adjust the funds rate to bring down the real cost of capital. but that's only if inflation is under control. As it is right now, the Fed is too tight. That is hurting businesses, that is hurting non-residential fixed investment, that is hurting housing, it's hurting the consumer. And when the Fed do bring those rates down, the real cost of capital is going to come down, and this is going to be a tailwind for the economy. When the Fed do cut rates, it's normally very good for stocks. In only 2 instances, 12 months later was the S&P 500 negative, Jan 2001, September 2007, the 12 months prior. And where we are right now in 2024 is nothing like these times at all. The economy was in complete shambles in 07, not so much in 2001, but things are looking rather robust and healthy in 2024. And this lends itself to one of these times right here, where we can actually see outsized returns, positive returns in the S&P 500 12 months down the track. And that's why I am long equities. But guys, looking at next week earnings, we have a very soft week of earnings, a light week of earnings, but still some big names. I think a lot of people are going to be watching stuff like Dollar Tree, Dick's Sporting Goods, because of all of the retail earnings we had in this past week. A lot of them were a dumpster fire, so they're going to be on watch. We also do get Broadcom on Thursday after the close, Neo as well, DocuSign, The Planet, and that's really it with big names. Earnings season really is coming to a close. However, we have a huge week of data next week. So we get a ton of manufacturing data on Tuesday, new orders, the employment index, manufacturing PMIs. Then we get some employment data on Wednesday, JOLTS, the Fed's beige book, as well as factory orders. Then Thursday is when things really kick off, because we get the ADP employment changes, initial jobless claims, non-farm productivity, as well as some more manufacturing data. And then Friday, we get non-farms, the big one. We get non-farm payrolls, the unemployment rate, as well as average hourly earnings. So from Thursday onwards, it's going to be a very data-driven week, especially as the Fed now move into their dual mandate with a real focus on employment. The non-farms print today is going to be really key to see if we get 25 or 50 basis points worth of cuts in September. Probably the biggest non-farms this year relative to what the Fed does. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, like this video, and leave a comment for the algorithm. Cheers.